Welcome to the Deep Dive. This is where we take your curiosity, grab a stack of, well, incredible sources, and really distill it all down into insights that you can actually use. Today, we're plunging headfirst into the world of trading. It's often misunderstood, isn't it? A place that promises so much freedom, but let's be honest, often delivers some pretty harsh lessons. We're aiming to cut straight to the core, though, using the brilliant insights from Dr. Alexander Elder's The New Trading for a Living. Now, this book is fascinating because it uniquely blends psychiatric understanding with, the cold, hard realities of the market. And you might be sitting there thinking, psychiatry and
Yeah.
trading, what's the link? Well, that's exactly where this deep dive gets really, really interesting. This exploration is definitely for you, whether you're just sort of dipping your toes into market speculation, maybe looking to sharpen up an existing strategy, or honestly just intrigued by the human drama behind all those flashing numbers. Our goal today, it's really to reveal how mastering your own mind, and then just as importantly, understanding the collective mind of the market crowd. Well, how that's far more critical to success than any super complex algorithm or, secret indicator.
Precisely. Our mission here is to pull out the most vital nuggets of wisdom from Dr. Elder's, groundbreaking work. We're putting a really strong emphasis on the psychological resilience and the disciplined approach he champions. We'll uncover those foundational truths that, let's face it, too often get brushed aside in that frantic chase for quick profits. Ultimately, the aim is to help you navigate these really dynamic markets with far greater awareness, control, and, frankly, a lot more serenity. What's truly striking about Dr. Elter's perspective is just how much of sustainable trading success is rooted not in complex maths, but in cultivating this unwavering self-mastery.
So Dr. Elder kicks off his book by painting this incredibly alluring picture, doesn't he? He calls trading the last frontier. He describes it as, a place where you can achieve genuine freedom, live and work from absolutely anywhere, completely on your own terms, independent from the typical 9 to 5 grind. I mean, just imagine making your own hours, being your own boss, conducting your business from, I don't know, a beachside cafe or some quiet mountain retreat, all fueled by your brain power. It's a really intoxicating vision, isn't it? Total autonomy. But then almost immediately he hits you with this stark reality check. He says, many aspire to it, but few succeed. This really seductive promise of freedom, he explains, often comes with a brutal reckoning. Most people fail, he says, for reasons that are pretty clear but often ignored, out of ignorance or from lack of discipline or because the game is hard. So it's not just about not being smart enough. It's usually a fundamental failure to really grasp the market's true nature, combined with a profound lack of that rigorous self-control needed to navigate its wild, unpredictable currents.
And if you look at Dr. Elder's own story, it just vividly underlines this truth. He arrived in New York back in 1974 with literally $25 to his name coming from Africa. Knew absolutely nothing about stocks or bonds or anything like that. It was actually a dog-eared paperback, something called How to Buy Stocks, that kind of opened his eyes to this whole new world. His first couple of trades, he actually made money, which unfortunately led to this delusion that making money in the markets was easy. A dangerous trap. He's very open about it, saying it took him a couple of years to really shake off that notion. And during this exact same time, his professional life was running on a parallel track. He completed a psychiatric residency, dived deep into psychoanalysis. It was this dual path, really, that gave him such a unique insight into trading, which he now shares so generously. His trading did slowly improve, but the real breakthrough, as he puts it, came when I realized the key to winning was inside my head and not inside a computer. And that realization is just pivotal. It directly connects his psychiatric expertise to the core theme of his work, that true market mastery. It starts within you.
Okay, that's such a powerful insight. It really makes you stop and think, doesn't it? And he emphasizes this point later, saying, psychology is important. Since I was actively practicing psychiatry while writing the original Tantity, Trading for a Living, its psychology part stood the test of time, and I changed it very little in this new edition.
Hmm. That's incredibly telling. I mean, especially when you consider how much other market stuff, tools, and dynamics have evolved over 20 years. But the core insights into human behavior, they remained. Just proves how timeless and fundamental they are. So what does this foundational role of psychology mean for you, the listener? It means that understanding your own mind, your emotions, your biases, your impulses, well, it isn't just some useful skill in trading. It is a foundational skill, full stop. Dr. Elder asks this really piercing question. Do you really want to succeed? And he illustrates it with that vivid story about his friend's wife. Remember
That weight loss story. Exactly. She says she wanted to lose weight, would even avoid cake in front of everyone. But then secretly, she was going at it with a big fork in the kitchen. She was prioritizing that immediate short-term pleasure of eating over the delayed gratification of actually hitting her goal. And this resonates so strongly with traders who claim they want consistent success, talk about long-term goals, disciplined strategies, but then time after time, they make impulsive, gambling-like trades. Maybe unconsciously, they're prioritizing the short-term thrills of just being in the action, or that emotional rush of a risky bet over the, let's face it, meticulous planning and patient execution that's essential for long-term gains. Dr. Elder firmly believes that genuine success demands treating trading as a serious intellectual pursuit, not just some emotional gamble. And that includes diligently practicing defensive money management, where protecting your capital is absolutely paramount. He makes an excellent comparison, too. A good trader watches his capital as carefully as a professional scuba diver watches his air supply.
That's a great analogy.
Right. Understanding that survival in that deep, unpredictable ocean of the market is the absolute #1 priority. So we all show up to the market carrying our own, unique mental baggage, our preconceived ideas, biases, those deep-seated beliefs that often operate just beneath the surface. Dr. Elder points out several widespread universal fantasies that traders tend to cling to. He compares them to children who are afraid to pass a cemetery or check under the bed for ghosts. These fantasies, much like a child's comforting idea of being adopted to explain a world that seems unfriendly and impersonal, might offer temporary comfort, but they critically stop a trader from facing reality head-on. They subtly, but profoundly, influence our behavior, often leading us down the wrong path. Let's shine a light on some of the biggest ones that consistently trip up aspiring traders. The first major fantasy he flags is the undercapitalization myth. This is that insidious little thought, if only I had a bigger account, I could have stayed in that trade longer and won. This belief often takes root after a trader gets wiped out, right? They then watch the market eventually move exactly where they predicted, but only after they were forced out. Oh, the worst feeling.
Absolutely. They sit there fuming, convinced they'd have made a fortune if they just had enough capital to ride out the storm for another week or month. And this experience, tragically, just reinforces the delusion that more capital is the magic bullet. But the hard truth, as Dr. Elder points out, is totally different. People manage to destroy accounts, big or small. It doesn't matter. He shares that really stark story about an acquaintance who blew out over $200 million in a single day.
$200 million.
Yeah. And even after a loss like that, this person still blamed external factors, repeating, "If only I had a bigger account." It just vividly shows that the real problem isn't the amount of money, it's internal. Dr. Elder's insight here is sharp, uncompromising. A losing trader is not undercapitalized, his mind is underdeveloped. The issue is psychological, plain and simple, not financial.
Right. And following closely on that, we hit the autopilot myth. This is that really tempting fantasy that the pursuit of wealth can be automated. Just buy or develop some automatic trading system and boom, profits roll in. Lots of intelligent people, maybe after years mastering demanding jobs, get lured into spending thousands on these systems. Often driven by, a mix of greed, maybe a bit of laziness, and surprisingly, a lack of understanding about probabilities.
Dr. Elder draws that fascinating comparison, doesn't he? Likening buying these systems to medieval knights who paid alchemists for the secret of turning base metals into gold. He explains the harsh reality. Markets aren't static. They're living, breathing, evolving things that constantly adapt. And that defeats rigid automatic trading systems. What worked brilliantly yesterday might be less effective today and probably won't work at all tomorrow. A competent human trader, they can adapt. An automatic system, by its very nature, just can't. He uses that really powerful analogy about airline pilots. Airlines pay pilots huge salaries despite having autopilots because humans can handle unforeseen events.
Like the roof blowing off an airliner.
Exactly. Or both engines failing over Manhattan. Only human skill saved hundreds of lives in those cases. His warning is crystal clear. Betting your money on an automatic system is like betting your life on an autopilot. The first, truly unexpected market event, he warns, will likely cause your account to just crash and burn.
Makes perfect sense. And finally, we get to the guru worship myth. This is that deeply held fantasy that someone else, some wise guru, can somehow make you rich. Dr. Elder breaks gurus down into 3 main types: market cycle gurus, magic method gurus, and, interestingly, dead gurus. Market cycle gurus, often seen in the stock market, predict these grand rallies and sharp declines. Their fame often balloons when market conditions just happen to align with their pet theories. Kind of like fashion models whose popularity shifts with public taste.
Right, timing is everything for them.
Totally. Then you have the magic method gurus. They're more common in derivatives, selling what they claim is a new set of keys to market profits, maybe some mystical speed line or a unique take on market profile. Traders like those medieval knights looking for the perfect sword are often willing to pay big bucks for what they hope is an effortless path to wealth.
But Dr. Elder points out a crucial dynamic. These methods inevitably lose their effectiveness as more people jump on board.
Yeah.
Markets are forever grinding down each method's edge. What worked when it was niche stops working when it's common knowledge. Gurus, he notes, always seem to emerge from the fringes, but all gurus crash when their methods get accepted by the mass media. So when you see that hot guru suddenly featured in Forbes or Businessweek, that's often a pretty clear sign their peak effectiveness is probably behind them.
Good indicator.
Definitely. And Dr. Elder himself firmly rejects the guru label. He prefers to share his modes of research and decision-making, emphasizing again and again that no guru is going to make you rich. You have to work on that yourself.
Such an important clarification. Which leads us to ask, if these external fantasies are so common, what about our own internal struggles?
Dr. Elder speaks really powerfully about self-destructiveness, doesn't he?
Oh, absolutely. He identifies it as the underlying cause of most failures, not just in trading, but, well, in life generally. It's this unconscious wish to fail that subtly but powerfully shows up as self-sabotage in our work, our relationships, our finances, everywhere. He tells that vivid story of his brilliant friend who had this lifelong pattern of just demolishing his own success. This guy, a successful pharmacist, lost his business, became a broker, rose to the top, got sued. As a trader, he repeatedly busted out.
And each time, he meticulously blamed external forces. Envious bosses, incompetent regulators, and an unsupportive wife. He just couldn't see the deep underlying pattern of self-sabotage. Trading, unlike many other jobs with safety nets, like watchful bosses or supportive colleagues, offers endless opportunities to self-destruct. There's no one there to tap you on the shoulder and say, hey, maybe don't do that. The market just silently takes your money. Curing this insidious pattern, it requires profound self-awareness, a willingness to take full responsibility for your results, and critically, diligently, keeping a trading diary. You have to look for those repetitive patterns of success and failure. It's about becoming your own honest observer, isn't it?
Absolutely. That insight about self-sabotage actually connects to another really unique parallel Dr. Elder draws, trading lessons from AA. Now, how can principles designed for recovering alcoholics possibly apply to the, ruthless, high-stakes world of financial trading? It seems incredibly counterintuitive at first, yet he argues the core ideas of Alcoholics Anonymous are profoundly effective for traders battling their own self-destructive tendencies.
It's a fascinating link.
It really is. The first bedrock step in AA is to admit that one is powerless over alcohol. For traders, this translates directly and powerfully to admitting powerlessness over losses. It's about acknowledging that trying to control the uncontrollable the market's next move is fundamentally a losing battle. He even proposes a Losers Anonymous, explaining that a harsh name helps focus attention on our self-destructive tendencies, just like Alcoholics Anonymous shows its direct name over something softer like Problem Drinkers Group.
Right, facing it head on.
Exactly. He even mentions a successful, deeply religious woman trader he knew. She cuts her losses very fast because it would not please the Lord for her to lose his money. That shows a powerful, principled commitment to minimizing capital loss. He uses that compelling analogy, too. Imagine a race between a sober man and a drunk. Who do you bet on?
The sober man, obviously.
Right. Similarly, Losers Anonymous thinking generates serenity, a state of mind that frees a trader to focus solely on the best and safest trades, unburdened by the tension and impulsive actions that plague emotional traders. This calm mindset is the fertile ground for rational decisions. A critical concept he introduces here is businessman's risk. He defines this as the absolute maximum a trader may risk on any trade, rigorously set at 2% of their account equity. So, for example, with a $30,000 account, you simply cannot risk more than $600 on any single trade, period. You must avoid risking more than 2% on a trade the way a recovering alcoholic avoids bars. Treat it as an inviolable, life-saving rule for long-term survival.
That 2% rule is foundational.
Absolutely. And the importance of records, which we touched on earlier, gets hammered home here, too. Poor record keeping is a sure sign of a gambler. Good businessmen keep good records. Your trading records, he insists, have to be comprehensive. Date, price, slippage, that little difference between your intended price and the actual fill price, which can really add up commissions, stops, any adjustments you made, your exact reasons for getting in and getting out, your profit goals, the maximum paper profit or loss during the trade, all of it. This meticulous documentation becomes your personal, brutally honest teacher, Finally, he suggests a meeting for one. Just like recovering alcoholics constantly remind themselves they are alcoholics for the rest of their life, to stay sober, traders should remember they are losers. Not in a bad way, but to stay relentlessly focused on avoiding losses, keeping humility and discipline right at the forefront of every single decision.
So if we kind of zoom out now from individual psychology, we quickly realize it's only one part of the puzzle, right? Markets are way more than just collections of individual decisions. They are crowds. And crowds, as history shows us again and again, behave in predictable, often deeply irrational ways. Each tick on your quote screen, Dr. Elder reminds us, represents a deal between a buyer and a seller. Prices, therefore, aren't some absolute truth. They're a momentary consensus of value of all market participants expressed in action. But this consensus is fluid, it's dynamic, and it's heavily influenced by collective emotions, fear, and greed, mostly. Dr. Elder emphasizes that crowds behave alike in different cultures on different continents. There's this powerful, almost primitive, strong urge to join the crowd and act like everybody else. This deeply ingrained impulse, he warns, almost inevitably clouds your judgment when you go to place a trade. The sheer power of the crowd is immense, which leads to a crucial, almost golden rule for traders. Never buck a trend. Now, you certainly do not have to run with the crowd, but you absolutely shouldn't run against it. The smart, independent trader respects the crowd's strength, but doesn't fear it. A trader who truly thinks for themselves can take money from crowd members by recognizing and intelligently exploiting these predictable patterns of collective behavior.
That's where you really see the timelessness of these ideas, isn't it? It instantly makes you think of Extraordinary Popular Delusions and the Madness of Crowds by Charles Mackay. Dr. Elder mentions that book specifically. It's fascinating how these patterns of human behavior are literally centuries old. Mackay, writing way back in 1841, vividly detailed historical manias like the infamous tulip mania in Holland
Yeah, the classic example.
and the devastating South Seas bubble in England, events where collective irrationality just led to widespread financial ruin. Gustave Le Bon, a French philosopher, explored similar stuff in his big work, The Crowd, back in 1897. The enduring, maybe slightly depressing lesson from these historical accounts, as Mackay famously put it, is that men go mad in crowds and they come back to their senses slowly and one by one.
That captures it perfectly.
Right. That slow, often painful process of individual realization after some period of collective craziness. Dr. Elder also wisely quotes Mark Douglas, who brilliantly said that in the market, there is no beginning, middle, or end, only what you create in your own mind. Douglas goes on, rarely do any of us grow up learning to operate in an arena that allows for complete freedom of creative expression with no external structure to restrict it in any way. This profound lack of external structure, Elder notes, makes us humans prone to instinctively seek leadership in uncertain times, which often leads straight to herd behavior. When people join crowds, their thinking becomes primitive and they become more prone to act on impulse. He gives the example of a scientist, cool and rational in his lab, who can make harebrained trades after being swept up in the mass hysteria of the market. The antidote, Dr. Elder insists, is to diligently write down and scrupulously follow your trading system and money management rules. These represent your rational individual decisions made calmly before the emotional storm hits.
That's a crucial distinction because it makes you wonder, are all groups bad for traders? Not necessarily, right? Dr. Elder also points to The Wisdom of Crowds by James Surowiecki, which offers a different, maybe more optimistic view. He carefully distinguishes between a typical group where members constantly influence one another and often fall prey to that emotional contagion, and what he calls a smart group. In a smart group, all members make independent decisions without knowing what others are doing. This unique setup allows for the true combination of diverse knowledge and expertise without the emotional waves and irrationality that so often plague typical market crowds. The key, it seems, is keeping that independent decision-making process intact, even within a collective setting.
Okay, so given all of this about crowd behavior, how does it actually impact information flow? In such a crowded, dynamic market, who genuinely has an edge? Dr. Elder dives into the different types of information and who really benefits. Let's talk insider information. He explains that legal insider trading, where corporate insiders, typically groups of 3 or more execs or large stockholders, consistently buy low and sell high, especially in clusters, often leads to profits. Their collective actions, if you can spot them, often signal significant things about to happen.
The smart money moving first.
Exactly. Then, of course, there's illegitimate insider trading. While the tip of the iceberg has been shaved down, meaning, some high-profile cases get prosecuted, its bulk continues to float largely unseen. He uses that evocative analogy of golfing buddies at a country club, exchanging tips safely and undetected, shows how hard it is to police these networks. Interestingly, he notes insider trading is actually legal in futures markets. Big firms also have sophisticated intelligence networks, like his oil firm friend who got a telex about a North Sea fire before it hit the news, letting him buy oil futures minutes before prices shot up.
Wow, talk about an edge.
Right. An individual trader working from home, he notes, is never the first to hear the news. The squawk box on a trading floor, for instance, gives real-time info that individuals just don't have. So what is your advantage as an individual? Most private traders, Dr. Elder observes, fritter away this fantastic advantage by overtrading. Your real goal, therefore, should be to trade well, not to trade often. Cultivate patience, ruthlessly eliminate greed, rather than desperately chasing every news flash.
Makes sense. Patience over frantic activity.
Definitely. Dr. Elder also highlights the critical importance of consensus and commitment indicators as tools to gauge that overall crowd sentiment. The contrary opinion theory suggests that when financial journalists and newsletter writers, who together act as a pretty good proxy for the general market crowd, become intensely bullish or bearish, it almost always pays to trade against them. They tend to overstate trends and miss turning points, creating prime opportunities for the smart contrarian. As Dr. Elder puts it succinctly, when the crowd becomes highly bullish, get ready to sell, and vice versa. This powerful idea was famously described by Mackay and later applied to markets by Humphrey B. Neal.
Still relevant today, too. Firms track this stuff.
Absolutely, like Investors Intelligence polling market advisors. Another essential tool is the commitments of Futures Traders Reports, or COT reports. These reports, put out by the CFTC, break down the positions held by different players. Hedgers, large speculators, and small traders. Hedgers are generally seen as the smart money today, using futures to offset risk in their actual businesses. Small traders, conversely, are typically characterized as eternally optimistic and often end up on the wrong side of major market turns. By diligently comparing current positions to historical norms, you can gain invaluable insight into the market's likely direction. You can see when the smarter money is quietly building positions or subtly getting out.
Okay, so we've explored the internal psychological battles, the external forces of the crowd. Now, the really crucial question becomes, how do we actually protect ourselves financially from the, well, often brutal realities of the market? Dr. Elder is absolutely unequivocal here. He stresses that risk management is essential for survival and success. It's not just a suggestion, it's a non-negotiable prerequisite for anyone who's truly serious about this.
You just can't skip this part.
No way. He identifies the inability to manage losses as one of the absolute worst pitfalls. Traders, he observes, frequently freeze like deer in the headlights or just stubbornly hold a losing trade, fueled by this desperate hope it'll miraculously turn around. This all too often leads to snowballing losses that can completely wipe out an account. And then, to add insult to injury, the market has this perverse habit of reversing direction right after the amateurs, who just can't take the pain anymore, finally give up and bail out.
Ouch. Reinforces all the wrong lessons.
Totally. Shatters confidence. To combat this self-destructive cycle, Dr. Elder introduces the foundational concept of the iron triangle of risk control: entry, target, and stop. These, he explains, are the three essential angles that must be defined for every single planned trade. Placing a trade without clearly defining these three numbers, that's just gambling, plain and simple. You absolutely have to know your precise entry point, your expected profit target, and your absolute maximum loss point, your stop, before you ever commit a single dollar.
That's a critical framework. So how do we implement this systematically? Dr. Elder provides two incredibly powerful safety nets. He likens them to the vital protection needed for performing a high-wire act in the markets. These are his two main rules of risk control, meticulously designed to shield your account from both the sudden, catastrophic losses and the slow, insidious bleed from lots of smaller losses. The first is the 2% rule. This rule strictly limits the loss on any single trade to no more than 2% of your total account equity. Its main job is to save your account from shark bites, those devastating single losses that can effectively take you right out of the game. For instance, if you have a $50,000 trading account, your absolute maximum risk you can accept on any one trade is $1,000. Full stop. This rule also directly tells you your position size. Let's say your stop placement on a potential trade means risking $1.50 per share. That's the distance from your entry to your stop. You calculate your maximum position size by dividing your max dollar risk, $1,000, by your risk per share, $1.50. That gives you what, about 666 shares. For futures trading, this rule is especially truly critical. Futures are deadly, not mainly because they're complex, but because of those paper-thin margins and enormous leverage.
Right, that leverage can cut both ways fast.
Exactly. Imagine controlling $100,000 worth of crude oil futures with only $5,000 in your account. That's 20 to 1 leverage. It means a tiny 1% move against you wipes out 20% of your capital. A 5% move against you could wipe out your entire initial margin. It allows a tiny price wiggle to just devastate your equity if you're not careful. The second, equally vital safety net is the 6% rule. This rule sets a limit on your total monthly loss, no more than 6% of your account equity as it stood at the very beginning of that month. This rule basically protects you from being nibbled to death by a pack of piranhas, a series of small losses that might not seem lethal on their own, but collectively can strip an account bare. The core concept here is available risk. Before you place any new trade, you have to meticulously calculate the sum of all losses you've taken that month, plus the potential risk on all your currently open trades. If that cumulative sum hits 6% of your starting monthly equity, you are then absolutely prohibited from placing any new trades until the month ends or until existing trades move significantly in your favor, allowing you to raise stocks and cut your risk.
That takes serious discipline.
It does. Dr. Elder tells a powerful story about a trader who'd lost money for 13 days straight. He was coached to drastically cut his share size from 500 down to just 100 and instructed to only slowly increase it after achieving 2 consecutive profitable weeks. Initially, the trader resisted, but soon he started reporting consistent, albeit small, profits. He made very little money because of the 100 share size, but he was ahead of the game. This just perfectly illustrates how those psychological wins and consistent small gains are absolutely critical for rebuilding confidence and enabling real financial recovery. The success of many institutional traders, he notes, often comes from having a trading manager who rigorously enforces strict risk limits, much like that 2% rule. When these same successful traders go solo, many unfortunately fail because they lose that external enforced discipline. It just underscores how much we humans need strict, non-negotiable risk management.
So those are incredibly robust rules for financial protection. But what does all this mean for building a truly reliable, sustainable trading approach? Do we just need a system? Dr. Elder says unequivocally, yes, systems are absolutely essential. They are built when you are calm and rational, serving as an anchor of rational behavior amidst the turbulence of the live market. He thoughtfully differentiates between mechanical and discretionary trading systems.
2 different flavors, basically.
Right. Mechanical systems, he explains, operate on strictly defined rules. No wiggle room. This approach can certainly relieve a trader from the intense stress of making constant decisions. However, there's a significant catch. Mechanical systems, he warns, eventually self-destruct because, say it with me, markets keep changing.
They're not static machines.
Exactly. The market is a vast, evolving crowd of human beings constantly adapting. Human judgment, therefore, is always required to adapt to genuinely unforeseen events. Discretionary systems, on the other hand, offer more flexibility. They stay open to fresh opportunities, are more finely tuned to subtle market shifts. Dr. Elder ultimately advocates for a kind of hybrid approach, using mechanical rules as a powerful filter to weed out potentially bad discretionary trades, ensures that even with flexibility, a core set of rational boundaries are rigorously kept.
Best of both worlds, maybe.
Kind of. Now, when it comes to testing systems, Dr. Elder strongly cautions against relying only on backtesting software. While an impressive printout looks like a very thin read, he argues, it fundamentally fails to prepare you for the emotional roller coaster of consecutive losses or the practical challenges of, say, gap openings in real-time trading. He instead passionately recommends manual, one-bar-at-a-time testing. This method, okay, it's slow, it's time-consuming, you can't automate it, but it's the only method that comes close to modeling real decision-making. By diligently moving through historical data day by day, making explicit buy-sell-hold decisions, and meticulously recording them, you genuinely test and improve your decision-making skills. You experience the market's raw, uncertain, hard right edge, much more authentically.
Builds that muscle memory, almost.
Exactly. Paper trading. Pretend trading with no real money at risk also has a true purpose beyond just simulating profits. Its real value is to test your discipline as well as your system. It's like sailing on a pond. It does little to prepare you for real sailing on a stormy sea, he admits, but it's an invaluable step to prove you have the consistency and grit to stick to your plan when things get tough, even without real money pressure. Once a system is thoroughly tested and your discipline is confirmed through paper trading, Dr. Elder advises starting with small, real money trades. Use tiny positions, only gradually increase your size once you achieve consistent positive results over time. This methodical scaling ensures you build both confidence and capital together, step by step. All right, now that we've built this really solid foundation in psychology and risk management, let's turn our attention to the practical tools, the things that help us actually read the market, Dr. Elder talks quite profoundly about the revolution in technical analysis, contrasting his early, super labor-intensive days of charting with today's incredibly advanced capabilities. He recounts his early experience with his very first computer for technical analysis, an Apple IIe desktop. It had 2 floppy drives, each holding a tiny 300 KB diskette.
Wow, hard to imagine now.
Totally. He even describes deciding to buy a then massive 5 MB hard drive, which at the time seemed too huge for anyone to ever need. Shows how far we've come. The impact of this computer revolution, he emphasizes, has been profound. Computers have liberated us from the routine updating of charts, freeing up time for thinking. They offer immense analytic power at a very low cost. But there's also a significant trade-off, he notes. We lose that intimate physical feel for price moves that comes from pencil and paper charting. Nevertheless, computerized technical analysis is undeniably more objective than classical charting. An indicator is either clearly rising or falling. There's no room for subjective guessing about its direction.
Remove some of the guesswork.
Exactly. He also draws a crucial distinction between toolboxes and black boxes. Toolboxes, he explains, provide electronic tools for processing market data, but they allow for extensive customization. They empower traders to build their own analytical frameworks. Websites like stockcharts.com are great examples, free or cheap, yet powerful tools for self-directed analysis. Black boxes, on the other hand, are presented as pure magic. It tells you what and when to buy and sell without telling you why. They always come with impressive track records of past performance, but Dr. Elder warns they eventually self-destruct because, as we keep saying, markets keep changing.
A recurring theme.
Right. His firm conclusion is pretty stark. The only way to make money from a black box is to sell one. He asserts that complex human activities like trading just cannot be fully automated or boiled down to a magic button. He does acknowledge a middle ground, gray boxes, which disclose their general principles but allow you to tweak parameters, offering more flexibility than totally opaque black boxes. The core insight here is that real power in trading comes from understanding your tools and building your own conviction, not from blindly following some magic button. A black box makes you dependent, a toolbox makes you a master craftsman.
That's a vital distinction. So with all this raw market data flying around, how do we actually begin to make sense of it all? It really is like trying to decipher a complex language, full of nuances and often hidden messages. We need to break down its fundamental parts. Let's start with the basic chart components. Bar charts and Japanese candlesticks are fundamental. They show the open, high, low, and close prices for a specific period, plus volume. On a candlestick chart, a white or green body usually means the closing price was higher than the open bulls won that round. A black or red body means the close was lower, bears won. The wicks, or shadows sticking out above and below the body, show the extreme highs and lows reached during that time, illustrating the full battle between bulls and bears. Interpreting the bar height, the range from high to low, is also key. An average bar marks a relatively cool, calm market. Tall, stretched-out bars mean a boiling market with intense conflict and participation. While those tall bars might be good for taking profits on existing positions, trying to enter a new trade during them is like jumping onto a moving train. It's often safer and more disciplined to wait for things to cool down a bit.
Good point. Less frantic entry.
Exactly. Then there are support and resistance levels. Dr. Elder describes them with that simple yet powerful analogy, like a floor and a ceiling, with prices sandwiched between them. These levels aren't just random lines on a chart. Their psychological basis is deeply rooted in the collective emotions of traders specifically. Masses of traders feel pain and regret. Those holding losing positions want to get out as soon as the market gives them another chance to break even, creating resistance overhead. Conversely, those who missed a chance to buy or sell earlier feel regret and also wait for the market to give them the second chance at a particular price level, thereby creating support below. These powerful collective emotions are what solidify these price zones. Importantly, they are better drawn across the edges of congestion areas where the most trading actually happened, rather than just connecting the absolute extreme price points, which often reflect fleeting panic. And a word of caution about false breakouts. Amateur traders tend to eagerly chase these breaches of support or resistance, while professionals tend to trade against them, knowing that many breakouts often fail in reverse.
The fade strategy takes nerve.
It does. Understanding the difference between trends and trading ranges is also absolutely crucial. Dr. Elder points out that markets actually spend the majority of their time chopping around in trading ranges, oscillating sideways rather than trending strongly up or down. These two different market states demand completely different tactics. In strong trends, you might use wider stops to give the trend room to breathe, following its strength. In ranges, you generally need tighter stops aiming to buy weakness near support and sell strength near resistance. He highlights the hard right edge problem. The past is fixed and clear, meaning old charts show trends beautifully, but the future is fluid and uncertain. You have to make trading decisions right now facing that daunting uncertainty. Trying to be right, he cautions, is an unaffordable luxury in the markets. Professionals, unlike amateurs, get out of losing trades fast rather than stubbornly clinging to a position just to prove their initial analysis was correct.
Letting go of ego, basically.
Pretty much. Ego is expensive in trading.
So we're peeling back the layers here. What specific tools beyond these basic chart elements does Dr. Elder recommend to help us spot these crucial trends and shifts in market psychology? He gives an important warning first. Don't look for a silver bullet, a single magical indicator that solves everything. Markets are just too complex for that. Instead, he recommends using a small number of indicators from various groups and learn to combine them, always remembering that most indicators are derived from the same 5 core pieces of data: open, high, low, close, and volume.
Diversify your indicators, essentially.
Exactly. Let's start with exponential moving averages, EMAs. Their main purpose is identifying trends and potential reversals. The key difference from simple moving averages is that EMAs give greater weight to the last trading day's price. The logic is that the latest mood of the crowd, reflected in recent price action, is considered more significant. Dr. Elder suggests using dual EMAs and the value zone. For example, pairing a 26-day and a 13-day EMA, roughly a 2-to-1 ratio, on a daily chart. The area between these two EMAs then becomes a value zone, where buying or shorting opportunities often pop up during temporary pullbacks within a trend. He uses a Disney DIS daily chart as a classic example, showing how pullbacks to value often offer really attractive buying opportunities within an established uptrend.
Buying the dips in an uptrend, basically.
Precisely, but in a defined zone. Next, we have moving average convergence divergence, or MACD lines and MACD histogram. Developed by Gerald Apple, MACD uses 3 EMAs to measure momentum and spot potential trend reversals. The real genius of MACD, Dr. Elder reveals, often comes from spotting divergences. He says they're often so clear they seem to jump at you from the charts. A bullish divergence happens when prices make a new low, but the MACD histogram makes a shallower low. This signals that the bears are losing power, selling pressure is drying up, even before the price itself turns up. He points to the DJIA weekly chart during the 2007-2009 bear market bottom as a prime example of this powerful signal.
A leading indicator, in a way.
Kind of. Conversely, a bearish divergence is when prices make a new high, but the MACD histogram makes a lower peak. This indicates the bulls are running out of steam, like at the 2007 bull market top. A key subtle condition for a true divergence, he notes, is that the MACD histogram must cross and recross its zero line between those peaks or troughs. That confirms the shift in momentum.
Good detail to know.
Yeah, crucial nuance. The directional system, ADX, is another powerful tool in the kit. Its specific job is to identify both the direction and the strength of a trend. The ADX line itself measures the spread between the positive, plus DI, and negative DI directional lines. A rising ADX, he explains, indicates a strengthening trend, either up or down. One of its most potent signals happens after the ADX falls below both directional lines, identifying a flat, sleepy, non-trending market. When the ADX then rallies significantly from below both lines, it rings a bell, signaling the start of a new, potentially powerful trend.
Waking up from a slumber.
Exactly. The Force Index offers a brilliant way to combine price and volume, showing whether the head and the heart of the market are in gear with each other. A short-term 2-day EMA of the Force Index is sensitive enough to pinpoint crucial pullbacks during established trends, offering optimal entry points. For instance, on an Adobe ADBE daily chart, if the weekly trend is clearly up, the 2-day Force Index dropping below zero can identify excellent buying opportunities during those short-term daily pullbacks. A longer-term 13-day EMA of the Force Index is then used to confirm major trends and signal potential reversals via divergences, similar to MACD.
So short-term for tactics, long-term for strategy.
Pretty much. Finally, volume and open interest offer crucial insights into the underlying psychology of the market crowd. Volume, he explains, reflects financial and emotional involvement as well as pain. Falling volume often signals that the supply of losers is running low and a trend is ready to reverse, as fewer participants are panicking out. Volume spikes, on the other hand, are more likely to signal the reversal of downtrends, which are usually fear-driven, intense but short, than uptrends, which are often greed-driven, slower, and steadier. Open interest, which applies specifically to futures and options, reflects the intensity of conflict between bulls and bears. Rising open interest during a price decline, for example, is often bearish. It suggests active bottom picking that will likely get squeezed if prices keep falling. Conversely, falling open interest during a rally can also be bearish, as it might mean existing longs are taking profits and shorts are covering, suggesting the trend is losing fuel.
So many layers to read. Which brings us to a key challenge, doesn't it? How do we reconcile signals that might conflict across different time frames? A weekly chart might look bullish, but the daily looks shaky. This is precisely where Dr. Elder's triple-screen trading system becomes so invaluable. It offers a highly structured, disciplined way to navigate the market's multi-layered movements. He observes this fascinating pattern. Every time frame generally relates to longer and shorter ones by a factor of 5. So a 10-minute chart relates roughly to an hourly chart, 6x, close enough, and a daily chart relates to a weekly chart, 5x.
Interesting rule of thumb.
Yeah. The triple screen system rigorously emphasizes starting always with the longer time frame for a strategic view and then switch to the shorter time frame for tactical timing. This core principle prevents the noise and whipsaws of smaller time frames from overriding the dominant longer-term market direction. Screen 1 is all about identifying the market tide, the overall weekly trend. You'd use a trend-following indicator like the MACD histogram slope here. This weekly trend acts as a powerful sensor, strictly permitting only trades that align with the prevailing tide. You only look for buys in a weekly uptrend, only shorts in a weekly downtrend, or you wisely stand aside if it's unclear. Dr. Elder's impulse system, which visually colors bars green for bullish, red for bearish, or blue for neutral based on EMA and MACD histogram readings, also serves this critical censorship role. It clearly tells you what you're not allowed to do. For instance, never buy on a red, bearish impulse bar.
Okay, so screen 1 sets the direction. What's screen 2?
Screen 2 focuses on identifying the market wave. This means pinpointing those optimal counter-trend moves within the intermediate time frame, usually daily charts, for precise entry points in the direction of the weekly trend. Here, you'd use oscillators like the 2-day force index, stochastic, or RSI. So if your weekly trend, screen 1, is clearly up, you then look for daily dips on screen 2, perhaps when the 2-day force index drops below 0 as prime buying opportunities rather than chasing strength higher. While he doesn't explicitly detail a screen 3 in this text, the system implicitly calls for a third step, often involving an even shorter time frame or a specific chart pattern for the exact entry trigger.
Like an hourly or 15-minute chart for the trigger?
Potentially, yes. For time frame examples, for swing trading, you might pair weekly and daily charts. For day trading, maybe 25-minute and 5-minute charts, or even those specific 39-minute and 8-minute charts he mentions for U.S. stocks, the general rule is pick your main intermediate chart, then pair it with a long-term chart that's roughly 5 times longer. Finally, when setting stops and profit targets, the triple screen calls for setting your profit targets based on the longer-term chart, like aiming for a key weekly resistance level or the weekly value zone we discussed. But crucially, you place your protective stops based on the intermediate time frame, G, the daily chart. This powerful strategy allows you to aim at the greater results while holding down the risk. Your tactical exits are sensitive enough to protect capital, while your strategic goals remain ambitiously aligned with the bigger market tide.
Okay, we've built a really robust framework now. Psychology, risk management, analysis tools. Let's quickly scan the actual instruments, the trading vehicles available to you out there. What should you know about stocks, ETFs, options, futures, and forex, especially through Dr. Elder's, well, often cautionary lens?
He definitely has strong opinions on these.
He does. First, stocks. Simple enough, right? Certificates of ownership in a business. While fundamental values earnings, company health certainly drive prices in the long run, John Maynard Keynes famously said, "In the long run, we're all dead." In the short term, it's the masses of people and their ever-shifting expectations driven by those primal forces of greed and fear that truly drive prices, often in profoundly irrational ways. Warren Buffett's Mr. Market analogy is perfect here. Imagine this manic depressive fellow showing up daily, offering to buy or sell his shares. Most of the time, you should wisely ignore him because he's crazy and his mood swings are unreliable. But when he's deeply depressed and offers his shares dirt cheap, you buy. And when he's wildly manic and offers an insane price, you sell. The real challenge, Dr. Elder notes, is not getting infected by Mr. Market's moods yourself.
Easier said than done sometimes.
For sure. For practical trading, he strongly advises against spreading yourself too thin. Instead of trying to track thousands of instruments, focus intently on a handful of stocks. He refers to his own harem of maybe 200 stocks he watches broadly, but from which he meticulously narrows down to just a select few for active trading. quality over quantity.
Makes sense. Next up are ETFs, exchange-traded funds. They seem incredibly attractive, right? Easy diversification. But Dr. Elder issues a stern warning about the hidden costs. He points out there are really two ETF markets. There's the primary market, the domain of authorized participants, big broker-dealers who buy and sell at wholesale prices. And then there's the secondary market, where private traders like you operate, effectively always sitting in the back of the bus. These administrative expenses and often poor tracking abilities result in what he calls haircuts. A Morgan Stanley study, for example, showed ETFs missed their stated target by an average of 1.25% back in 2009. That adds up.
Definitely eats into returns.
Absolutely. Dr. Elder recounts vivid examples of failure. A friend who tragically lost $1 million on a volatility ETF, VXX, which just steadily declined 90%, even while the underlying VIX index fluctuated wildly. He also highlights how many commodity and country ETFs track their underlying assets pretty poorly. His warning is blunt: buyer beware. And always remember that old saying, Kenstefel, there ain't no such thing as a free lunch.
Good reminder. Okay, what about options? They present a different, equally complex set of challenges. Dr. Elder is pretty blunt about the odds here. An option buyer has 1 chance out of 3 to win, but the odds are 2 out of 3 in favor of an option writer. Professional traders, he notes, often sell poor buyers hope, selling calls or puts that frequently expire worthless, allowing the writer to just pocket the initial premium paid. Time decay is the seller's friend.
Selling theta, as they call it.
Right. He discusses naked writing calls or puts often way out of the money, expecting them to expire worthless. This leverages that time decay. This strategy, while it sounds super risky, can actually have better risk reward than perceived if managed with extreme discipline. But, and this is a huge but, naked writing means selling options without owning the underlying stock. Potential losses are theoretically unlimited if the market rips against you. Definitely for advanced pros, not beginners.
Huge risk potential there.
Massive. For buying puts, he argues, it only really makes sense when you're aiming for an exceptional gain from a major reversal, like hoping for a 10-fold gain or better. In those rare, high-conviction situations, he recommends buying very cheap, far out of the money puts. They're priced like a cheap lottery ticket. You accept the high probability of losing the whole premium for that small chance of an outsized, exponential win.
Okay, what about CFDs, contracts for difference?
Right, CFDs. They're essentially a bet on the future value of a currency, an index, or a stock. Very similar to spread betting. And tellingly, they are banned in the U.S. by the SEC. Dr. Elder draws a strong comparison to how the FDA commendably kept thalidomide out of the U.S., sparing people from its horrible effects. He suggests regulators took a similar protective stance against CFDs. Australia's ASIC, for instance, considers them riskier than gambling on horses or in casinos. They note CFDs are heavily marketed to new, inexperienced traders, hyping up exaggerated gains while glossing over the profound risks involved.
Sounds pretty predatory.
It often can be. Now, futures. Futures contracts have a definite size and a fixed settlement date, which provides a unique reality check for traders. Unlike stocks, where most people only buy, in futures, long and short positions are always equal, so you have to be comfortable playing both sides. However, the failure rate in futures is alarmingly high. 9 out of 10 newcomers are said to bust out in the first few months. This, he argues, is largely due to a gross lack of risk management skills and newcomers being seduced by paper-thin margins.
Back to that leverage danger.
Exactly. Those incredibly small margins, often just 3–5%, allow for enormous leverage. A mere $40,000 account might control $1 million worth of merchandise, making them deadly for amateurs without iron discipline. Dr. Elder recommends futures only for serious traders with absolutely excellent money management skills. He advises starting in markets where you have some fundamental knowledge, like a cattle rancher trading cattle futures, or in inexpensive, highly liquid markets like corn, sugar, or copper.
Makes sense. Stick to what you know or start small. And finally, forex.
Forex, the foreign exchange market. This is a decentralized market, no central exchange. A characteristic that allows bucket shops to thrive by preying on clients, often actively wanting them to lose. These shady brokers frequently engage in fraud, like slicing bid-ask spreads, manipulating buy and sell prices to guarantee they profit, subtly draining your account. They might also charge arbitrary daily resettlement fees on non-existent positions, just another way to siphon off your capital. The biggest danger in Forex, though, comes from homicidal leverage. Offers like 100.1 and even 400.1 leverage are common.
400 to 1. That's insane.
It's truly insane. This extreme leverage ensures that the slightest price wiggle against him is guaranteed to wipe out his equity with terrifying speed. Dr. Elder recounts a cautionary tale about a multimillionaire stock trader student of his. This student opened large forex accounts and placed unusual and atypical size orders late at night, specifically to see if the brokers were bucketing them, meaning the broker was taking the other side of the trade instead of sending it to the real market. The result: only 2 out of many houses tested didn't bucket the trades, starkly highlighting the prevalent fraud in this largely unregulated space. Buyer definitely beware in Forex.
Okay, we've covered a huge amount of ground, explored many complex topics, but perhaps the single most powerful habit you can cultivate, the one that really underpins everything else, is robust record keeping. As Dr. Elder profoundly notes, memory is the cornerstone of civilized life. Without accurate, detailed records, those hard-won lessons are just inevitably lost, and costly mistakes are absolutely doomed to be repeated.
Forgetting is expensive in trading.
Extremely. The value of these records is truly immense. It turns you into your own teacher, helping you learn systematically from your successes and, maybe even more importantly, from your failures. It actively fights against that random reinforcement, those occasional lucky wins that happen for the wrong reasons. Those accidental wins, he warns, actually subvert our discipline and subtly encourage sloppy, inconsistent trading. This is precisely why diligent, honest record keeping isn't just helpful. It's absolutely essential for long-term improvement.
So what does that look like in practice?
Well, Dr. Elder advocates for a comprehensive daily homework routine. The purpose is to establish a consistent pattern for the market even opens, ensuring you get in gear with the market with a calm, analytical mindset, not rushing decisions. He describes his own multi-version spreadsheet. He was up to version 3.7 when writing the book, which tracks critical global market factors. This includes checking overseas markets, Australia, China, Germany's DAX, UK's FTSE, meticulously reviewing the economic calendar for upcoming news releases, monitoring key currencies, euro, yen, key commodities, oil, gold, bonds, and even the Baltic Dry Index, which he considers a sensitive leading indicator for the global economy.
Wow, that's thorough.
Very. He also checks general market breadth indicators like the new high, new low index, the percentage of stocks above their 50-day moving average, and the force index, noting their impulse system colors, green, red, or blue. He even daily tests his market expectations, coloring a box green or red based on whether the market closed higher or lower than its open. Finally, his routine concludes with an "Are you ready to trade today?" self-test. A quick but critical psychological check on his physical feeling, how yesterday's trading went, planning completeness, and overall mood. A 0 rating on some of the questions, he stresses, also warns me not to trade. That powerfully highlights how crucial personal well-being is for consistent trading performance. You can't trade well if you're sick, stressed, or distracted.
Makes perfect sense. Okay, what about planning individual trades?
Right. Another absolutely critical element is creating and scoring trade plans, using what he calls trade bills and a trade Apgar. A meticulously written trade plan acts as your island of sanity amidst the market's chaos. It clarifies your entry, target, stop, and precise trade size before emotion can take over. The trade Apgar is this ingenious system he developed, inspired by Dr. Virginia Apgar's scoring system for newborns. He actually references Nobel Prize winner Daniel Kahneman's discussion of it and thinking fast and slow.
Oh, interesting connection.
Yeah. For traders, its purpose is to objectively rate potential trade ideas using a simple 0, 1, or 2-point system across key categories. Things like weekly income status, daily impulse, any divergence present, support resistance levels, and critically, the reward-to-risk ratio. This highly effective tool helps you quickly identify the healthiest ideas and traps the rest before you commit any capital. Dr. Eld notes how a professional option writer he knew customized his own trade Apgar, swapping some indicators and adding option-specific questions, showing its adaptability. The go-no-go decision rule derived from this system is strict. Only trade ideas with a score of 7 or higher and not a single line rated 0 should ever be pursued. It acts as an incredibly high-quality filter for your trading decisions.
So you're only taking the A-plus setups?
Exactly. Beyond the initial trade plan, a comprehensive trade journal is truly indispensable. It is, he emphasizes, what serious traders do. A common thread he found among all the successful traders he interviewed for his book Entries and Exits. This journal includes not just the initial plan of results, but crucially, mandates diligent post-trade analysis. He recommends revisiting every trade 2 months after the exit and review it with the benefit of hindsight. Create follow-up charts to see with a clearer, less emotional perspective what I did right or wrong. Tracking equity curves, charts of your account balance over time broken down by market, by strategy, even by exit tactics, like those labeled couldn't stand the pain, provides invaluable, sometimes painful feedback. Seeing an equity curve nosedive specifically for exits marked couldn't stand the pain, he says, will ensure you never trade without stops. Once you visually see the devastating impact of those emotional exits on your capital.
That visual feedback must be powerful. So, after diving so deep into all these principles, what does this truly mean for the big picture? This isn't just about becoming a trader overnight, is it? It feels much more like a continuous, lifelong journey of self-improvement.
Absolutely. Dr. Elder touches on that famed 10,000 hours rule for achieving true expertise, often cited for elite athletes or musicians. For a full-time trader, that could easily take 5 to 10 years. He also mentions Josh Kaufman's The First 20 Hours, suggesting basic competence can be achieved much faster with focused, deliberate effort. However, Dr. Elder ultimately emphasizes that trading is profoundly a lifelong pursuit, even for the most seasoned pros like himself. He states it so powerfully. I reserve the right to be smarter tomorrow than I am today.
Love that quote.
Me too. It highlights that the learning never ever truly stops. It's an ongoing journey of constant self-improvement, adaptation, and unwavering humility in the face of the market. Hashtag outro.
Wow. What an incredible deep dive into the complex mind of a trader and the equally complex mind of the market crowd. We've explored Dr. Alexander Elder's truly unique blend of psychiatric insight, rigorous discipline, and practical market tools. From those seductive illusions peddled by financial gurus to the life-saving precision of his 2% and 6% rules. We've seen how understanding crowd behavior is as ancient as the tulip mania itself, and how your personal discipline, evidenced by things like meticulous record-keeping and that trade Apgar system, is ultimately your greatest asset in this game.
Indeed. This deep dive has profoundly shown us that trading isn't just a game of flashing numbers on a screen. It's a deep, often introspective study in human behavior, both our own individual quirks and the collective currents of the crowd. It's about being that sober man in the race, as he put it, and having the unwavering integrity to stick to your carefully crafted plan, especially when things get tough and no one else is watching. Because at the end of the day, that internal manager, your disciplined self, is often the stark difference between enduring success and just repeating the same costly failures.
So here's a provocative thought for you to mull over as we wrap up. If the market truly offers, as Mark Douglas said, complete freedom of creative expression with no external structure to restrict it, then maybe the true ultimate frontier of trading isn't actually out there in the volatile charts and the flashing numbers. Perhaps, just perhaps, it's deep within your own commitment to self-mastery, unwavering integrity, and consistently disciplined decision-making. Thank you for joining us on this deep dive. Until next time, keep learning, keep questioning, and keep exploring.